Looking forward to what the Fed has to say. Fed Chair Jerome Powell, my goodness, Super Bowl type day for him. The Fed is expected to raise rates by 25 basis points this afternoon, bringing the target rate to a 22-year high. Joining us now to break down this is Yahoo Finance reporter Jennifer Schonberger. Jennifer, great to hear from you. Great to see you. I mean, I got to imagine Fed Chair Jay Powell wakes up this morning, pours himself a fresh pot of coffee, and he's ready to go. He's rearing to discuss this with his FOMC members.
Hey there, Brad. Good morning. Great to see you as well. Indeed, officials about an hour into the second day of their two-day policy meeting here in Washington, where they are widely expected to raise rates by another quarter percentage point and keep the door open for additional rate hikes later this year. Take a look at those Fed funds futures this morning. They are pricing in nearly a 100% chance of the Fed raising rates by 25 basis points this afternoon. Now, a 25 basis point rate hike would mark the central bank's 11th rate hike in nearly a year and a half after taking a breather in June. It would take the benchmark interest rate, the Fed funds rate, to a range of 5.25% to 5.5%, marking a 22-year high. With no new interest rate projections or economic forecasts released at this meeting, all eyes will be on Fed Chair Powell's press conference and the outlook for monetary policy. Powell is likely to talk tough on inflation and suggest another rate hike in September could be possible to avoid loosening financial conditions. Wilmington Trust Chief Economist Luke Tilley telling me, I think that they'll still need to talk a little bit tough and hawkish. They need to acknowledge the CPI data, but also talk about risks because they don't want financial conditions to ease up. Now, last meeting, officials penciled in 2 more rate hikes for the second half of this year based on higher expectations for core inflation. The Fed now expects inflation to end the year closer to 4%, up from 3.6% previously. That would be nearly double still, though, the Fed's 2% target. Of course, an interest rate hike this afternoon would mark the first of potentially 2 more rate hikes this year. Guys, this interest rate decision coming down at 2 p.m. Eastern, followed by Fed Chair's press conference at 2:30 p.m. Back to you.
Look forward to your coverage from there, Jen. Thanks so much. Appreciate it.
Thanks, Julie.
It is indeed decision day for the Federal Reserve, which is expected to raise rates by another quarter point at today's meeting, bringing the target rate to a 22-year high. This is going to be the 11th hike in the cycle. It's expected to maybe be the last, depending on who you speak to. One of the people who is expecting that is Julia Coronado, MacroPolicy Perspectives founder and president. Julie, good morning. It's good to see you. So you think this is going to be the last one. Why?
Well, as you noted, the Fed has a forecast of core PCE inflation close to 4% this year in Q4 of this year. And that's just much higher than the data are tracking. So by the September meeting, they're going to have 2 more inflation prints in hand. It's going to be very clear that that forecast is overly pessimistic, and they're going to have to lower their forecast. So remember, they took a pause in June. That was, Chair Powell described that as slowing the pace. So we're going to hike today, and that means the next hike would be slated for the November meeting. But by September, it's going to be pretty clear that inflation is tracking lower. It'll be the first downward revision in their forecast in a long time. It'll still be running above their target, but at least it's moving in the right direction, which suggests it's time to shift to the next phase of their strategy, which is just higher for longer. They don't need to keep raising rates, just hold them at a higher level. Apply that restraint on the economy, let inflation move lower gradually, and then over time you can start cutting rates. That's the phase we're entering, we think, fairly soon.
Okay, and so if entering that phase fairly soon, by when or how early could we see some type of cut from your perspective or estimation?
Well, that's, again, barring a recession, which we do not have a recession in our baseline. If we go through a period of sort of trend to below trend growth with inflation gradually moderating, the Fed isn't going to turn around and cut anytime soon. We think that they'd like to have a 2 handle on the core inflation annual reading. So core PCE inflation dipping below 3%. We have that happening at the end of Q1 next year, early Q2, which means The earliest we see the Fed cutting, barring a recession, is about the May 2024 FOMC meeting.
Julia, first of all, do you think we're actually going to avoid the recession entirely? And secondly, how? Because it does seem like it is anachronistic, right? This current setup and environment and what we've been seeing.
Yes, it's been a very unusual cycle. And one thing that's been a huge headwind for the economy is just the operational frictions that have come with the pandemic, both the shifting demand, the supply chain frictions, the super elevated labor turnover. All of these things have made it hard for businesses to do business, to run their operations efficiently. We think we're right now in the early stages of a productivity dividend. So yes, top line growth has slowed. We are seeing a mild earnings recession this year, but it's not particularly severe because there are these offsetting tailwinds from lower labor turnover, from better supply chain functioning. And that's a unusual tailwind at this stage of the cycle, given and very particular to the pandemic recovery, that we think will help us kind of offset that tighter policy. Also, fiscal policy is going to be a moderate tailwind. Again, not a massive stimulus, but we do have a positive impulse coming from both state and local and federal governments, which is the mirror image of what we had last cycle, where it was a constant headwind for years. Now we've got a modest tailwind, and that, again, helps the economy be more resilient.
What could the Fed come out and say, and Fed Chair Jay Powell come out and say today that the markets might continue to look at and say, you know what, this is still all systems go with the move that we've seen in the past month for the S&P 500 up by about 5% over that time, that there still is more legs to this, especially if there are certain parts of the commentary that signal that everything is still looking good and soft landing is still very much the classification, or perhaps we just keep flying. Perhaps that's what they come out and say, even though they haven't necessarily leaned into our plane analogy as much as we want them to.
So I don't think that Chair Powell wants to further stimulate the stock market rally. That tends to be something that he sees as providing a little bit of a boost to the economy and making their jobs harder. I don't think we are in the phase where the Fed is micromanaging the stock market. And I think what Powell is going to remind the market today is that a soft landing also means higher for longer interest rates. If we skirt a recession, then there is no reason for the Fed to turn around and cut anytime soon. So soft landing also equals higher real rates. And that might be something that the market isn't putting completely together. We've gotten some relatively less bad news than expected on earnings. It's still not an earnings boom, nor is it an economic boom. Growth is running around trend. So it's not like all systems are go and we're entering a growth acceleration. And I think as the data, continue to paint that picture, that reality is going to be something that the market has to absorb. I think the new home sales data this morning are a good example. There's been sort of talk about a housing rebound. There is no rebound. Housing demand is bottoming at a fairly low level, given much higher interest rates. We do have a supply problem, and that has kept prices from correcting more. But it's not like home sales are going to be surging upward anytime soon, given that rates are going to stay high for a while.
So how long do you think we could stay at the bottom here of the housing market and kind of bump along?
I think for some time. I mean, we know that there is demand sort of from a demographic perspective. There is demand for housing, and we haven't built enough supply. So it's not like we need a major housing recession. But again, housing is more expensive. Affordability is a real issue. So between higher rates and lack of supply and homes that have appreciated dramatically over the last couple of years, the numbers just don't add up for a lot of people, and home ownership will be constrained for those reasons.
Julia, finally, I want to ask you about the bank deal that we heard about today, because obviously the banking industry has been such a source of focus for the Fed. PacWest being bought by Bank of California, they're getting some financing, some private equity financing as well. This implies that the sort of stress in the banking system was not all wrapped up and behind us, right? Is that your read of the situation? Right. What does it imply about what stress could potentially still exist?
I think that's an excellent way to read it. I think it's a reminder that the stresses on the banking system aren't all just bad management at one firm. It is the inverted yield curve. It is sort of a generational shock in interest rates that banks are having to grapple with, and as we just discussed, may not turn around anytime soon. And that's a reality that makes it hard for banks to make money, harder. And also they've faced more deposit flight and deposit sensitivity than they're used to. So this is a tough operating environment, particularly for mid-sized and smaller banks. It still is. That hasn't changed. And that is one reason that Chair Powell described the go slower strategy, was that this kind of credit constriction that we're very much in the middle of, it's not something that materializes from one day to the next. It takes some time. Economic models suggest this is a process that can take 12 to 18 months. So this credit headwind and these banking sort of stresses could be with us for some time. The Fed is going to have in hand at this meeting, by the way, the Q3 reading of the Senior Loan Officer Survey, which shows us how many banks are tightening credit standards and what's happening to loan demand. So the Fed will have that. We don't get that till Monday. But one thing that I look forward to hearing at the press conference is, what are they seeing in that data, and what does that make them think as far as how much credit constraint is going to do their job for them?
And just quickly, also on the docket, there is a hearing on Thursday at which regulators are going to consider some new capital requirements for banks and for a broader swath of banks, right? Does this sort of give them more ammunition? And do you think that that helps or hurts on balance from a credit perspective?
Well, it helps from a structural standpoint. One of the reasons that Silicon Valley Bank ran into trouble was because they grew very, very fast when those higher requirements were released in 2017 or were eased in 2017. So that will help restore some structural discipline in the banking system. But that also means, from a cyclical perspective, that credit is likely to be a bit of a headwind for the economy. So the Fed probably doesn't need to do as much with interest rates, because credit availability, the lending standards are going to be tightening for going forward over a decent period of time.
Yeah, really interesting stuff. Julia, thank you as always for your perspective. Julia Coronado, MacroPolicy Perspectives founder and president. Appreciate it.